The global health pandemic has forced many of you to work from home where perhaps you ordinarily wouldn't have. And it seems like this is a trend that is here to stay with some of you business owners and employees alike, drastically cutting down on office space. Spending more time at home usually results in higher personal expenses such as heat, light and other costs. But thankfully, there are methods you can use to benefit not only from tax relief on such expenses, but for you to reimburse yourself too. In this video, we are going to cover what exactly counts as working from home, for a sole trader, the proportion of costs method, for a limited company director, the rental agreement, and finally for everyone, the flat rate allowance method. Before I get into today's video, be sure to hit that subscribe button as well as the notification bell to make sure you're kept up to date with all our latest content. This really helps us to produce more helpful videos and to get you real quality advice from real qualified accountants. From a UK tax perspective, HMRC don't exactly specify an exact amount of hours that you need to be working from home in order to claim a working from home tax deduction, although some of their guidance does suggest 25 hours per month to be a reasonable level. In reality, the working from home tax deductions are designed to compensate those of you who incur additional expenses as a result of your home working situation. For this reason, it is more important that you can clearly demonstrate and evidence the increased expenditure. If you work one afternoon per month from home, for example, you would probably struggle to justify a meaningful claim, whereas if you had a dedicated room in your residence that doubles up as a home office and is used on a regular basis throughout the week, not only would your claim numbers be worthwhile, but you would also have a good basis to claim on too. At the beginning of April, we granted early access to the Accounting and Tax Academy membership site. In July of this year, we're opening our doors to everyone. Our members will have access to in-depth tutorials, free downloads, and exclusive discounts. And the best part is, it's absolutely free to join. Head to the link in the description box below to register your interest today. If you're a self-employed sole trader and you spend time working from home, then you may be able to claim the working from home tax deduction in one of two ways. The first option is to calculate what proportion of your home expenses relate to your self-employed business and include this as an allowable expense on your self-assessment tax return. The second is to use HMRC's approved flat rate allowances, which are determined based on the number of hours per month on average that you spend working from home. This option we discuss later on in this video, and it also applies to limited company directors. Under the proportion of expenses method, a self-employed individual can allow for a number of home expenses, and they include rent, mortgage interest, electricity and heat, council tax, internet and telephone, and other expenses that can be directly attributed to working from home. Once you have totaled up the related expenses, you will need to come up with a suitable way of splitting these costs between business and personal use. The most common way is to base the calculation on the number of rooms in the house. Let's say your residence has 6 rooms in total and you are using one room as a home office and work there on average 7 hours per day. Then the calculation would be as follows. You'll take the total of the related expenses times 1/6 times 7/24, which equals the allowable expense. This method can be a little more time consuming to calculate and will require you to keep detailed records of the calculation and supporting bills for 5 years following the 31st of January submission deadline of your self-assessment return, but will usually result in a greater allowable reduction when compared with the flat rate allowance discussed later in this video. If you're an owner director of a limited company, the rental agreement method involves your limited company renting space from your personal residence and paying a regular rent. The rent will be an allowable expense for your limited company and will benefit your company by reducing its corporation tax liability. Your claim falls into section 316A, IT 2003, home workers additional household expenses. So it's a useful way of extracting funds out of your company so long as you stay within the rules and the amounts can be justified in the event of a HMRC audit. Now, this is a crucial point. A non-exclusive license must be drawn up to document this transaction officially. This license sets out the basic terms for a non-exclusive license to rent part of a domestic property on a short-term basis. Without this agreement, HMRC may reclassify the rental payments as additional salary from the company, which will be subjected to both personal income tax of up to 45% and national insurance contributions of up to 12%. When preparing the license, license, it is important to establish a suitable rental rate that is consistent with the wider market. You should not charge a rent that is designed to be tax beneficial or biased to either party, that is your company and yourself. All in all, your numbers must be justifiable to HMRC, and this is an area HMRC supercomputers do check routinely, given its openness to abuse. If you require a non-exclusive license template along with the wording, then head on to the link below where you can download an agreement and fill in the details. And remember, you should also complete board minutes to record the agreement. If you are a one-person company, the Companies Act actually dictates that you must minute all agreements. A suggested way to calculate a rental amount is in the same way as a self-employed individual, used by totaling up the related expenses and consider the number of rooms in the house as part of the calculation. Alternatively, for a more accurate calculation, you could base the calculation on square footage occupied for business use. The agreement should be signed by both the individual and a representative of the limited company, and quite often this often ends up being the same person acting in different capacities. However, you should seek professional advice before adopting this method, as renting part of your home in this way can possibly lead to HMRC retracting capital gains tax exemptions that normally apply to your main residence, such as principal private residence relief known as PPR. Essentially, HMRC could argue that the space used by the limited company no longer qualifies for the main residence PPR exemption, which could make you liable to pay capital gains tax on part of the property should you ever sell your house. As a minimum, it is usually suggested that the room rented by the limited company is not used exclusively as an office, hence the non-exclusive license agreement. If you also make use of the room for non-business purposes, then this will lend support to claiming a greater amount of the property is exempt from capital gains tax as a main residence. Again, this can be a tricky area to navigate, so if in doubt, do speak to a professional about your specific case. Another option, whether you operate through a limited company or as a sole trader, self-employed, is to claim the flat rate allowance. This method differs for limited company owner directors and a sole trader as follows. For limited companies, the flat rate allowance is currently £6 per week in the 21 to 22 tax year and can be paid from the limited company to you, the director shareholder. It will also be included as an allowable expense by the limited company, resulting in a reduced corporation tax liability overall. For the self-employed, the claim for the flat rate allowance is based on the number of hours on average that you spend working from home. The table on screen shows the rates that have been approved by HMRC in the current year. It is important to note that if you work less than 25 hours per month from home, then you are unable to use this method. This method is obviously much easier and quicker than the proportion of expenses method discussed earlier in the video, and does not require any supporting documentation to be kept. The disadvantage of using this method is that as a general rule, the allowable deduction is usually a lot lower than when using the proportion of costs method. I hope this video has helped you understand how to sensibly choose and calculate a home office tax deductible expense and taken you one step closer to knowing your numbers. As always, let us know in the comments your thoughts on today's video, or if there are any topics you'd like us to cover in the future. Finally, be sure to like and subscribe, as this does help us to get our content out there. This is Tony D'Angelo for the Accounting and Tax Academy. Thanks for tuning in.